Title: The Psychology of Money, 18 Mental Traps That Keep People Poor. What if I told you that the biggest threat to your financial future isn't inflation, isn't a recession, and isn't even a lack of money? What if the real threat is the person staring back at you in the mirror? Most people believe money is about intelligence. Learn enough, work hard enough, invest correctly, and wealth will eventually follow. But if that were true, every smart person would be rich, every financial expert would retire wealthy, and every lottery winner would stay rich forever. Yet reality tells a completely different story. People earn fortunes and lose them. Others build lasting wealth while earning average incomes. The difference isn't knowledge. The difference is behavior. Because money isn't just numbers on a screen. Money is emotion. Money is fear. Money is greed. Money is patience. Money is psychology. And whether you realize it or not, your psychology influences every financial decision you make. The way you spend, the way you save, the way you invest, even the way you define success. In his best-selling book, The Psychology of Money, Morgan Housel explains a powerful truth. Doing well with money has little to do with how smart you are, and a lot to do with how you behave. Today, we're going to uncover 18 psychological traps that quietly sabotage wealth. Some of them are obvious, most of them are invisible. But once you see them, you'll never look at money the same way again. Let's begin. The first trap is believing you're logical. Think about two investors looking at the exact same stock. One believes it's a huge opportunity, the other believes it's incredibly dangerous. How can both people see the same information and reach completely different conclusions? Because nobody experiences money objectively. Every financial decision is filtered through personal experience. Someone who lived through a market crash may fear investing for the rest of their life. Someone who became wealthy during a bull market may believe taking risks is easy. Someone who lost money in cryptocurrency may avoid it forever. Someone who made money from cryptocurrency may see it as the future. Same information, different experiences, different conclusions. The dangerous part is that we often mistake our experiences for reality. We assume the way we see money is the correct way to see money. But our experiences represent only a tiny fraction of what's actually happened in the world. Your financial beliefs are not necessarily facts. They're often reflections of your past. And the moment you realize that, you become a better decision maker. The second trap is believing you're completely in control. People love success stories. We read biographies of billionaires. We study wealthy entrepreneurs. We search for the secret formula behind their success. Because deep down, we want to believe success is predictable. Work hard, make good decisions, become wealthy. But reality is far more complicated. Every success story contains two invisible ingredients: luck and risk. Consider Bill Gates. Without question, he is brilliant. But he also happened to attend one of the very few schools in America that had access to a computer terminal during the early 1970s. That opportunity gave him a massive advantage before most people had ever touched a computer. Now imagine someone equally talented who never received that opportunity. Would their outcome be the same? Probably not. That's not unfair. That's reality. Luck matters, risk matters. And understanding that makes you humble. Because when things go well, you don't assume you're invincible. And when things go badly, you don't assume you're a failure. You simply focus on what you can control and respect what you can't. The third trap is believing stories instead of facts. Humans are natural storytellers. We love narratives. We love heroes. We love dramatic success. And that's exactly why stories can be so dangerous. Imagine hearing about someone who bought a lottery ticket and won $200 million. Suddenly, buying a ticket feels reasonable, not because the odds improved, because the story influenced your emotions. The same thing happens in investing. People hear stories about ordinary individuals becoming millionaires overnight. They see luxury cars, private jets, massive gains, and suddenly they stop evaluating risk. They stop asking questions. They stop looking at the numbers. Instead, they start chasing a dream. That is exactly what happened during countless financial bubbles throughout history. People weren't buying assets. They were buying stories. And eventually, reality caught up. Whenever an opportunity sounds exciting, ask yourself one simple question. Am I following evidence? Or am I following a story I desperately want to believe? Because that single question can save you years of financial regret. The fourth trap is thinking you're a spreadsheet. Most financial plans look brilliant on paper. Perfect asset allocation, perfect savings rate, perfect investment strategy. The problem? You are not a spreadsheet. You're a human being. Humans get scared. Humans panic. Humans compare themselves to others. And humans make emotional decisions when life becomes stressful. That's why the best financial plan isn't the most mathematically perfect one. It's the one you can actually follow. A strategy that earns slightly less but helps you sleep at night is often better than a perfect strategy that causes you constant anxiety. Because the greatest investment plan in the world becomes worthless the moment you abandon it. Successful investors understand something most people don't. Consistency beats optimization, every single time. The fifth trap is never defining what enough means. This trap has destroyed more wealth than almost any market crash in history, because the word more has no finish line. You earn more money, then you want a bigger house, you buy a bigger house. Then you want a better car, you buy a better car. Then you want more status, more recognition, more admiration. The target keeps moving, and eventually you're running a race that can never be won. History is full of wealthy people who already had everything they needed, but risked it all for something they didn't. Not because they were poor, because they never learned the meaning of enough. The truth is simple. If you can't be satisfied with enough, you'll never be satisfied with more. Real wealth begins when you stop asking how much more you can get and start asking how much is already enough. The sixth trap is believing possessions create admiration. Many people spend years chasing luxury items, the expensive watch, the luxury car, the dream house. Not because they truly want those things, but because they believe those things will earn respect. Here's the irony. When someone sees a Ferrari driving down the street, they rarely think about the owner. They imagine themselves driving it. When someone sees a luxury watch, they don't admire the person wearing it. They imagine how it would feel on their own wrist. People aren't thinking about you nearly as much as you think. They're thinking about themselves. This is one of the most expensive misunderstandings in personal finance, because it causes people to spend enormous amounts of money trying to impress people who aren't paying attention. Real admiration comes from character, not possessions. Kindness, integrity, humility, reliability. Those things create lasting respect, not the logo on your shirt. The seventh trap is confusing looking rich with being rich. At first glance, they appear identical, but they couldn't be more different. Looking rich is easy. Being rich is difficult. Looking rich means spending money. Being rich means keeping money. Looking rich gets attention. Being rich creates freedom. Most people see the luxury car. They don't see the debt. They see the expensive vacation. They don't see the credit card bill. They see the beautiful lifestyle. They don't see the financial stress hiding behind it. The problem is that society rewards visible wealth. Nobody notices the money quietly invested every month. Nobody applauds the person who chooses not to upgrade their lifestyle. Nobody celebrates discipline. But discipline is exactly what builds wealth. Real wealth is invisible. It's the money you didn't spend, the investments quietly compounding in the background, the opportunities created by financial security. And that's why many people who look rich aren't wealthy, while many truly wealthy people don't look rich at all. The eighth trap is falling for fear disguised as wisdom. Bad news spreads faster than good news. A market crash becomes front-page news. Years of steady economic growth barely receive attention. Why? Because pessimism sounds intelligent. When someone predicts disaster, people listen. It feels cautious, responsible, realistic. Optimism often sounds naive, yet history tells a different story. Humanity has survived wars, depressions, financial crises, pandemics, political turmoil. And despite all of it, progress continued, innovation continued, economic growth continued, the stock market continued. This doesn't mean bad things won't happen. They absolutely will. The lesson is that temporary setbacks are not the same thing as permanent decline. Successful investors understand this. They expect problems, but they also expect recovery, because every generation believes its challenges are unique, and every generation underestimates humanity's ability to adapt. Fear is powerful, but long-term optimism has historically been far more profitable. At this point, you may have noticed something surprising. None of these traps are about intelligence. They're about emotions. They're about human behavior. And that's what makes them so dangerous, because intelligence alone can't protect you from them. The next traps become even more powerful because they influence the way you save, invest, and build wealth over decades. And unlike market crashes, these mistakes often happen quietly, without warning, without headlines, without you even realizing it. The ninth trap is believing saving money needs a specific goal. Most people think saving only makes sense when there's a purpose: a new house, a new car, retirement, a vacation. But one of the most powerful ideas in wealth building is that saving doesn't always need a destination. Sometimes saving is simply about creating options, because the future is unpredictable. Jobs change, opportunities appear, emergencies happen. And when they do, the people with savings have something incredibly valuable: flexibility. Imagine two people earning the same income. One spends almost everything. The other quietly saves a portion every month. 5 years later, both face an unexpected challenge. One is trapped. The other has choices. That's the hidden power of saving. It buys freedom. Freedom to wait. Freedom to leave a bad job. Freedom to take a risk. Freedom to survive difficult times. Most people think wealth is measured by income, but often it's measured by how long you can maintain your lifestyle without earning another dollar. The 10th trap is wanting investment returns without paying the price. Everyone wants extraordinary returns. Nobody wants volatility. Everyone wants the rewards. Nobody wants the discomfort. But investing doesn't work that way. Every reward has a cost. And in investing, that cost is uncertainty. The market doesn't hand out returns for free. It charges an emotional fee. Fear, doubt, stress, regret. Watching your portfolio fall 30% during a market crash feels terrible, but that discomfort isn't a sign something is wrong. It's the price of admission. The problem is that most investors mistake volatility for failure. They panic, sell, and abandon their strategy. Not because the strategy failed, because they couldn't tolerate the emotional cost. The most successful investors understand a simple truth: temporary pain is often the fee you pay for long-term success, and those who accept that fee are usually the ones who benefit most from compounding. The 11th trap is believing getting rich is the hard part. Getting rich is difficult. Staying rich is even harder, because they require completely different skills. Building wealth often requires risk, optimism, bold decisions, but preserving wealth requires caution, patience, discipline, humility. Many fortunes have been built. Far fewer have survived. History is filled with people who earned millions only to lose everything. Not because they lacked intelligence, because they underestimated the importance of survival. The greatest investors don't focus on maximizing returns. They focus on avoiding ruin, because once you're wiped out, the game is over. And the most important rule in wealth building is simple: stay in the game. As long as you're still playing, compounding can continue working in your favor. The 12th trap is underestimating the importance of a margin of safety. Most financial plans assume things will go according to plan. Life rarely does. Unexpected expenses appear. Investments underperform. Businesses struggle. Jobs disappear. The future has a habit of surprising us. That's why the smartest people leave room for error. They save more than they think they'll need. They spend less than they can afford. They prepare for outcomes they hope never happen. Because confidence is useful, overconfidence is dangerous. A margin of safety creates resilience. It allows mistakes without disaster. And in finance, resilience is often more important than brilliance. The 13th trap is underestimating the power of time. Most people think wealth is created through extraordinary returns. In reality, wealth is often created through ordinary returns sustained for extraordinary periods of time. Consider Warren Buffett. Many people focus on how much money he has. Far fewer focus on how long he's been investing. The majority of his wealth was accumulated after most people would have already retired. Why? Because compounding is slow, then suddenly it's not. At first, progress appears invisible. Months pass, then years, and nothing seems to happen. But eventually, growth begins building on previous growth, and the results become extraordinary. That's the magic of compounding. It rewards patience more than intelligence, consistency more than brilliance, endurance more than talent. Most people quit before compounding has a chance to work. They want results immediately. They underestimate what 10, 20, or 30 years can accomplish. The truth is that wealth rarely arrives dramatically. It arrives gradually, quietly, patiently, year after year. And those who respect the power of time often discover something remarkable. The biggest advantage in investing isn't finding the perfect opportunity. It's staying invested long enough for ordinary opportunities to become extraordinary. But even time and patience aren't enough on their own, because the next psychological traps explain why some people still fail despite understanding everything we've discussed so far. And those traps may be the most important lessons of all. The 14th trap is ignoring how rare success really is. When we look at successful people, we often assume their journey was predictable. We see the outcome. We don't see the thousands of failures that came before it. The truth is that most success comes from a small number of extraordinary events. A single investment, a single opportunity, a single decision, a single breakthrough. And sometimes, that's all it takes. Think about the biggest companies in the world. Many struggled for years before becoming dominant. Think about the most successful investors. Many of their gains came from only a handful of investments. Yet people often believe they must be right all the time. They don't. You can be wrong repeatedly and still succeed if your winners are large enough. The problem is that most people quit after a few failures. They assume failure means the strategy doesn't work. In reality, failure is often part of the process. Success isn't about being right every time. It's about surviving long enough to catch the opportunities that matter. Because in finance, one great decision can outweigh dozens of average ones. The 15th trap is believing money is about buying things. Most people spend their lives chasing money because they believe money buys possessions, cars, houses, luxury, status. But those things are only a small part of the story. The greatest benefit of money isn't what it buys, it's what it allows. Freedom. The freedom to choose how you spend your time. The freedom to walk away from situations that don't serve you. The freedom to make decisions without desperation. The freedom to wake up and live according to your own priorities. This is the hidden purpose of wealth. Not consumption, control. Many people become trapped chasing material rewards while completely missing the real reward. Time. And once time is gone, no amount of money can buy it back. The 16th trap is expecting the future to be predictable. Human beings desperately want certainty. We want forecasts, predictions, expert opinions, anything that helps us feel in control. But the most important events in history were often impossible to predict. Financial crashes, technological revolutions, global crises, unexpected breakthroughs. Nobody saw them clearly before they happened. That's what made them surprises. Yet investors continue searching for certainty. The next market move, the next recession, the next big winner. The reality is that uncertainty is permanent, and the sooner you accept that, the stronger your financial decisions become. History isn't valuable because it predicts the future. History is valuable because it teaches us how people behave when the future becomes uncertain. And that lesson never changes. The goal isn't predicting every surprise. The goal is building a life that can survive them. The 17th trap is forgetting that you will change. Most people assume the person they are today is the person they'll always be. But that's rarely true. Think about who you were 10 years ago. Your priorities were different. Your goals were different. Your beliefs were different. Now imagine who you'll be 10 years from today. Chances are you'll change again. That's why rigid financial plans often fail. They're designed for a future version of yourself that doesn't exist yet. The career you love today may not excite you tomorrow. The lifestyle you want now may not matter later. The goals that seem essential today may become irrelevant. The smartest financial plans leave room for evolution. They create flexibility. They allow adaptation. Because life changes, and successful people change with it. The 18th and final trap is copying people who are playing a different game. This is one of the most common mistakes in modern finance. A friend makes money trading stocks. You want to trade stocks. An influencer gets rich from cryptocurrency. You want cryptocurrency. A celebrity buys something expensive. You suddenly want it too. But what most people fail to realize is that everyone is playing a different game. Different goals, different timelines, different responsibilities, different levels of risk. What works for one person may be disastrous for another. A 20-year-old investor and a 60-year-old retiree should not make the same decisions. A day trader and a long-term investor are not following the same strategy. A business owner and a salaried employee face completely different realities. The problem begins when you compare your journey to someone else's. Because comparison removes context, and without context, even good advice can become dangerous. The key is understanding your own game, your goals, your timeline, your definition of success. Once you understand that, outside noise becomes far less powerful, and that's where real confidence begins. Now think about everything we've covered. 18 traps, 18 ways the mind quietly works against wealth. And yet they all point to one simple truth. Financial success is not primarily about knowledge, it's about behavior. Most people know they should save. Most people know they should invest. Most people know they should avoid unnecessary debt. The challenge isn't information. The challenge is execution. The challenge is staying patient when others are impatient, remaining calm when others panic, thinking long-term when the world encourages short-term decisions, because the market doesn't defeat most people. Their emotions do. Fear, greed, envy, ego, impatience. These forces destroy more wealth than any recession ever could. But the good news is that behavior can change. Every great financial outcome begins with small decisions repeated consistently over time. A little more patience, a little more discipline, a little more humility, a little more perspective. That's how wealth is built. Not overnight, not through luck alone, but through years of making slightly better decisions than most people. Money compounds, but so do habits. So the question isn't how much money you can make. The real question is who you're becoming while you make it. Because in the end, your financial future is simply a reflection of your behavior. And that behavior starts changing the moment you become aware of it. If you enjoyed this video, subscribe to Money Road. Because every week we explore the principles of wealth, investing, psychology, and financial freedom. Not to help you get rich quickly, but to help you build lasting wealth that survives for decades. And remember, the greatest investment you'll ever make isn't in stocks. It's in the mindset that allows you to hold them.